also, one other thing, if they do end up increasing premium payments at some point, you do have the option of just taking decreased coverage. So, for instance, if you had a 4% inflation rider, and 15 years down the road, the carrier decides they want to increase your premiums by 25%, you can opt out of that premium increase and forgo your inflation rider. So there are some options there where the companies typically will work with you. But I just want to make sure everybody's aware of that because it's an important, it's an important idea to highlight. Just kind of in closing here, I just want to make a couple just generic statements about the whole, the whole concept. Some is always better than none. Getting some type of coverage is really important. And I would, like I said before, start at your company if you're employed, and you're employed by a corporation, or if you're not self-employed, I should say, because you're probably going to get the best deals from them. But you want to make sure that it's offering you, the type of coverage that you're looking for. If your disability coverage at work is only a 2-year own occupation and then switches to an ENEOC, you may want to look at supplementing with some private coverage. So you really want to have a good understanding of what your coverage looks like. But like I said, some is always better than none. Resist the desire to overinsure, the financial closet, right? We don't want to have too much insurance because it doesn't make sense. We want to create an emergency fund to supplement a longer elimination period. And again, I think that that's important just to make sure that you can really save on your premiums if you can increase an elimination period. Spend some time and ask yourself some what ifs. What if this happened to me? What if that happened to me? And then incorporate that into your financial planning conversations. If you have a couple of real kind of what if scenario conversations with yourself, and then you look at your financial plan and how your financial plan will be affected by those issues, those are the issues you should be protecting yourself using these types of insurance. So, ask yourself some what ifs and use that in doing a real analysis of your financial plan alongside, of course, with Debbie and Jim. You can review alternate funding sources. I mean, don't forget, for long-term care purposes, you're going to have Social Security. Maybe you have a pension. You have a retirement savings account. You have other investment accounts. So you do have other ways to fund these items, whether it be disability or long-term care. But you just want to make sure that it's not going to create a hole in your financial plan by using an alternate funding source. And what we do is we use these insurance programs to come in and supplement some of these holes inside of the plan if you already use alternate funding sources. I guess these are all kind of in the same genre. The cash flow analysis, design your coverage around a cash flow analysis so you know how much you're spending, that you can afford it, that you're not going to lapse the policy. No point in getting coverage and letting it lapse. That doesn't really do you a whole lot of good. So make sure that the coverage you're getting, you can afford it, and that it's the right coverage for you. And then I just ask, make sure you're planning for today so that you're prepared for tomorrow. And I think that's a mantra that we all kind of use in the planning world, is that we can only plan for what's going on today because we don't know what's going to happen to us in the future. But if you put together a plan today that addresses all the kind of the major life event issues, whether it be for the positive or for the negative, then that's a plan that can help you be prepared for whatever comes down the road. So I certainly appreciate everybody's time today. If anybody has a question, they can feel free and chime in with it. If not, Debbie, I really appreciate it. Thanks for having me on.
Yeah, wonderful. Great, Ray. And Jeanette, just let me know that we don't have any questions, but I will ask if any of our participants do have any questions, feel free to type those in as I'm making my closing remarks. And we want to make sure that, we speak to any questions, concerns, reservations, pushbacks on actually getting the insurance. So if they occur later, feel free to email me. I certainly have Ray's contact information. You can contact him directly. And I'll just conclude by saying that, Ray, you did a wonderful job highlighting the issues around these very important pieces of a financial plan. And we recognize that they're not the funnest things to talk about. We'd much rather focus on what your goals, your fund goals are within the plan to travel and explore, new ideas and experiences once you do reach retirement. But that's part of the important work that that you we do here at Lighthouse Financial Planning is taking a look and making sure that we, provide for those what if and heaven forbid situations. And once we go through, do the analysis, figure out, what is the appropriate coverage, well then, the lion's share of the work is done, and we just, touch on it, focus not very, very heavily on all of these items on a regular basis once we have the primary insurance and needs met. So with that, oh, it looks like we do have a question. Good. So Jeanette, do you want to let us read off the questions, please?
Sure. We have a few questions, and let's start with the first one, Ray. And the first question is, can long-term care insurance policies be purchased for a parent?
Absolutely, they can be purchased for a parent. We often see that, and I think it's a very good question. There's not a lot of ways to expand on it. There's a number of different ways to structure the policy, but you can absolutely purchase a long-term care policy for your parent.
Okay, great. And then the next question is, what are the advantages of buying a long-term care policy in your 50s versus your 60s and the premium price?
Well, there's two real advantages to buying in your 50s versus your 60s. The closer that you get to really 65, okay, the premiums will go up exponentially. So if you're buying at 55 versus 65, it's a pretty big gap in coverage. When I say pretty big, I'm saying several $1,000s difference in coverage. And the closer you get to 65, the more expensive that they typically get. Just so you know, married couples do get a pretty significant discount. If you're healthy, that's another area where you can get a pretty significant discount. So, on your marriage status and your health, and the only reason why married couples, get a discount, and that's, you both don't have to apply to get the discount, but they assume a caregiver. So if you're married, they assume your spouse will want to keep you in the house as long as possible and take care of you. If you both apply together, you will also get another discount. So there are ways to decrease the coverage or the premium cost, even if you're married and you're 65. There's a number of different items that they'll give you credit for. But the difference between a 55-year-old couple and a 65-year-old couple is going to be several $1,000s in a year for the same type of coverage. And whoever asked that question, if you're interested in seeing some exact numbers, just let Debbie know, and I'll get you just an example, and you can take a look and see what the numbers look like.
Okay, Ray, and then it looks like we have one last question, and they want to know, who are the major companies providing long-term care insurance at this point?
There's really 4 companies that you probably see that dominate the space. Genworth is number 1. They represent about 60%, 60, of the long-term care market. Transamerica being another option. Mutual of Omaha being a third, and then we do see MedAmerica, and there's a couple other John Hancock being the big 4. But then there's some smaller companies like a MedAmerica, and the name escapes me right now, but the big 4 are the 4 that I just mentioned: Hancock, Mutual of Omaha, Genworth, and Transamerica. And I think that as a company, you're probably going to see Genworth being in Trans being the most competitive in California, Transamerica. I'll write Genworth if I have to, because if the gap in premium is so significant, but it is a cause for concern that they own such a big portion of the market, and it's a market that you've seen companies not wanting to participate in. MetLife, Prudential are just 2 companies that in the last year exited the long-term care market due to pricing pressure. So I think that I like to look at not only the premium cost but also the potential for rising premiums when I do an analysis. So I'm looking at a lot of different things when I'm looking at the carriers, but those are the big 4.
Okay, great. And you know what? That looks like that was our last question.
Okay, great. Thank you, Jeanette, for doing those, and Ray, wonderful